Hi, I am Plummer from Alpha Beta IR Analytics. With this video, I would like to present the idea of alpha creation in active investment management. To get alpha, investors need information. Here, you are going to see how information could create alpha. I will give you an example from Hong Kong Stock Exchange, how much a real alpha could be achieved with the Hang Seng portfolio according to different level of information investors may have. The investors are differently informed and they apply different approach for their investments. Assume that you are one uninformed investor. That is, you don't know what to expect, which stocks will present better return during next period and which bet. You simply don't know which assets to invest in. In this case, the most suitable approach for you is CAPM. You can invest in an index presenting the market, but you are free to choose other indexes as a benchmark. From CAPM, you can calculate what the expected rate of return of one asset is. It is according to this formula. Being an informed investor, you know that only one factor, the benchmark, influences the expected return. Because everybody uses the same formula, this expected return we call consensus return, the return which the market expects from the stock. However, reality is always different from the models. Investors know that yes, in the future period some parts of realized return will be equal to the consensus, but there will be some plus or minus from the consensus. This is unexpected by CAPM part of return. We call it residual return. So you know that the future realized return will consist of these two parts, consensus return and residual return. Now it's time to forecast. To do so, we have to use CAPM. CAPM is good in establishing consensus return, but for the residual return, CAPM assumes that it is random variable with zero average and some standard deviation. You do not have enough information. You know that there will be some plus or minus residual return, but because it's random variable with average zero, you cannot formulate any expectations for that part of return. Therefore, you are confident only for consensus return, only for this part of return. You know how much it will be. However, for the other part, residual return, you know that it may appear, but because it is independent and identically distributed, you cannot form any expectation for this part of the return. You can just expect its average value, zero. Of course, this doesn't mean that an uninformed investor cannot apply some investment strategy. If residual return is random variable, it can be diversified away by constructing portfolio. You just invest not in one, but in many stocks. Notice that our subscripts here are P. If the number of assets is big enough, then diversification will eliminate residual return for the portfolio. And your expectation return for your portfolio will be equal to the consensus return. How? For some assets, residual return will be negative. For other assets, residual return will be positive. So, as an average, the value of residual return of all portfolio will be close to its average, which is zero. What is the benefit from this approach? Now you can be more confident in your expectations. You diversified away unexpected part of your expectations, residual return, and your expectation is equal only to consensus part of expected rate of return. This investment style is known as beta investing. It is applied by millions and millions passive investors. They just have to choose what beta they want and to construct portfolio with such a beta. Let's now assume that you are fully informed investor. You know all factors which influence the return from stocks. Therefore, you know which asset will outperform and which asset will underperform. You just follow your information. You know how to calculate the value of the stocks and you will invest in those which provides high return. You do not need to invest in portfolio but only in those stocks with higher value. Many investors think that they are fully informed. Warren Buffett is a good example for that. Of course, not everybody is Warren Buffett. You and me, both of us, know that it is impossible to know all factors influencing the return and to know exactly in which stock we should invest. There is a solution for us. This third approach. We are not capable enough to know which exactly stock to invest in. That is why we still invest in portfolio like the benchmark. We still know that as a whole, residual return of the whole portfolio will be close to zero. However, we also know that some stocks in our portfolio will deviate from their consensus level positively and some other stocks negatively. If it is so, we can come up with some great idea. What if we know which stocks will have positive and which negative residual return? Therefore, we need some partial information on which we can, or at least we believe, we hope, we feel that we can predict future residual return. Based on this information, we can forecast that some of stocks will provide positive residual return and some negative. This information not needed to be deep analysis of each stock. We just need which of the all stocks in our portfolio will divert positively from their consensus return and which negatively. In other words, we just have to know which are the best stocks and which are the worst stocks compared to average. Therefore, our expectation for future residual return for the stocks is not zero anymore, but some positive or negative value. That expectations of future residual return is called alpha in active management. So we have good opportunity to beat the benchmark because we have additional information. Our information allows us to predict future residual return, that is alpha of each stock. Knowing alpha from every stock, we can create alpha for our portfolio. If we know that some stocks in the portfolio will provide positive alpha, we are going to increase the weights of these assets in our portfolio. For other stocks, we forecast negative alpha. Then we can minimize their weights in our portfolio or even go short for these stocks. This is a summary of active management. Take a benchmark as a base, increase the weights of assets with positive alpha, decrease the weights of assets with negative alpha, and expect higher return than the benchmark. Let me repeat again the logic of active investing. Here we have all stocks in our portfolio. The consensus return for each of them is explained by CAPM. But we know that for each of them there will be residual return. For some positive, for some negative, but average for the portfolio will be about zero. Now we have information that for some stocks residual return will be above average, which is zero, and for some below. Imagine if we can forecast correctly alpha. That means that everything is concentrated in the information for alpha. Here I'm going to show you one hypothetical situation. We have calculated for 5 years period of time beta coefficients for all companies using monthly data for Hang Seng. We applied the simple CAPM using hypothetical RF of 1%. Column B presents the realized weekly return for some week in late 2018 for each stocks. Next column here presents the same return but annualized. Resultative consensus return is presented in column E. As you see, the consensus return is calculated by applying the standard formula. So here we have consensus theoretical return and here the real return. The difference between them is presented in column F. Actually, this is residual return from our formula. As we can see, sometimes this part can have very extreme values. Here, here, and here, here, here. We assume that weights of each stocks in our benchmark are equally weighted. As you see, our active weights are zero. That means that we invest in each stock exactly the same weight as in the benchmark. Understandably, investors cannot achieve any alpha. This is the return for one passive investor, which presents what would have been the result if we have invested in our benchmark that would have been achieved by passive investors. In this sheet, I marked this stock which provided positive residual return with red and those which provided negative with green. Now let's assume that you have had a very good information which has been so good that in the beginning of the period you have been able to forecast exactly which stocks will have positive alpha and which negative. That means that you predicted perfectly the sign of alpha. See, here you still don't have ability to predict how much will be the alpha. For those stocks which you predict positive alpha, you increase the weight double. For those you predict negative alpha, you give weight 0. So this situation means that your portfolio consists of investment double than benchmark weights in positive stocks and no investments in negative stocks. You see the result. Portfolio alpha is 21.60%. Therefore, if your information is good enough to tell you which stocks will have positive and which stocks negative alpha, and just by equally increasing the weights of those with positive alpha, you can enormously increase return of your investment. Of course, this is very unrealistic situation. Your information cannot be so perfect. In next sheet, we assume that your information has been enough to forecast the stocks with the 5 best alphas and the stocks with the 5 worst alphas. For those with the best alpha, you double the weights. For those with worst alpha, you invest 0 weight in your portfolio. And all other stocks, the weights are the same as in the benchmark. Result in our portfolio is this, 13% more than benchmark. Therefore, if your information is good, you can significantly increase your return. This could be real situation, but still too good for the real life. Now let's assume that your information is modest. You predict 5 stocks with a positive alpha, but it turned out that they were not the stocks with the best alpha. In other words, you were not so good in guessing exactly which are the 5 best alphas. The same for negative alpha. You forecast the 5 stocks with negative alpha but not the worst alpha. Again, for positive stocks, you double their weights. For negative, you decrease the weights to 0. For all other stocks, you keep the same weights as in the benchmark. Your information was modest. It gives you some ideas which stocks would have positive and which negative alpha, but was not able to tell you exactly the 5 best and the 5 worst stocks. In this very realistic case, your alpha would have been above 5%. This situation is very close to real. I hope that this simple example presented you the benefits of active management. Thank you for your attention.